Office market supply finally recovered in 2013. The new delivery amounted to approximately 900,000 square meters of offices. Moreover, it developed quite an aggressive pipeline for 2014. Given current status of the projects in the pipeline, in 2014 the new delivery may amount to 1.4 million square meters, which is comparable to pre-crisis volumes. In the beginning of 2014, tenants keep following the conservative policy of cost control, and this said, the new delivery may not meet sufficient demand. A little over 1 million square meters of offices were transacted in 2013. Baseline scenario is that the take-up for 2014 may be over 1.1 million square meters. 77% of the demand is concentrated on Class B. Approximately 80% is coming from the Russian companies. While international players have been quite passive in 2013, they demonstrate growing activity in 2014. As a result, the majority of transactions occurs in the area between the third transportation ring and MCAD. In 2014, strong delivery will be observed in the Moscow city. Besides, the following schemes may be highlighted: K2, Vodny, Bolshevik, third phase of Arcos. Class A new delivery in 2014 may amount to 580,000 square meters. A combination of quite aggressive supply and constrained demand may create additional pressure on commercial terms to the end of 2014. Rental rates may drift towards the lower borders of their range, which are in Class A prime 1,100 to 1,200 US per square meter, in Class A 650 to 750, and in Class B 400 to 450 US dollars per square meter per year. Vacancy rates are expected to be under the upward pressure in 2014. Class A vacancy rate may grow up to 18%, and Class B vacancy will fluctuate around 10–11%. This tendency will become most powerful in the fourth quarter of 2014, where the largest amount of space will be delivered to the market.
In 2013, 262,000 square meters of the new retail space were delivered in Moscow. As a result, penetration rate reached 340 square meters per 1,000 inhabitants. It's still below the penetration rates typical for the European cities, which are 450–600 square meters per 1,000 inhabitants. Developers announced 900,000 square meters to be delivered in 2014. It's more than 1.5 times higher than it was in 2009, the previous record year. As usual, not all of the announced schemes will get open on time. According to our estimates, 2014's new delivery could amount 500 to 600,000 square meters. The most noticeable schemes in Moscow will include Vegas Crocus City, Mozaika, Avia Park, and Vesna. More than 1 million square meters of retail space will be delivered outside of Moscow and St. Petersburg. 2.6 million square meters announced to be appear in 2014, providing a good ground for setting up a new historical record. Worsened macroeconomic situation, specifically decrease in GDP and retail turnover growth figures, is expected to calm down developers' activity. As a result, forecasted new delivery will be much lower than announced, but still might exceed 1.3 million square meters. The strongest developers' activity is observed in Yekaterinburg, Samara, Novosibirsk and Ufa. Developers are still mainly focusing on the regional and super-regional formats of the shopping centers, with a large entertainment component and federal chains as anchors and mini-anchors. In a number of cities, overall retail space supply approaches the saturation stage, which increases competition and make the landlords of the first-generation malls think about reconcept of their project. Among the shopping centers that came through reconcept procedures in 2013 were Bashkortostan in Ufa, Moda in Kit in Yekaterinburg, Valna in Murmansk, and others. Rental rates for the premises of 100–200 square meters in Moscow Premium Shopping Center slightly increased and amounted to $2,060. Vacancy rate decreased to 2.6%, but may start growing in 2014 due to the expected strong new delivery. 33 international brands entered Russian markets in 2013. Most of them are clothes and shoe operators positioning in the medium price range. Shopping malls remain the most demanded locations to open the flagship stores, while street retail, in turn, in much rare case. In 2014, Moscow market will still remain attractive for the retailers. At the end of 2013, 17 more new brands announced their plans for Moscow market. Among them are such strongest players as Abercrombie & Fitch and Galeries Lafayette. Situation in the street retail remains stable. 100-200 square meter spaces sizes are still the most demanded. The most frequent tenants there are clothing and shoe operators, banks and catering. Vacancy rate is stable around 6.5%. Rental rates were smoothly growing during the year, though the prime rental rates remained at the same level, about $8,000 per square meter per year.
Despite a decrease of Russia's overall economic activity, the Moscow industrial and logistics market still feels very well and probably will feel well over the period of 2014. In 2013, we saw about 930,000 square meters of new deliveries, which was an increase of 12% in comparison to the total stock. Whereas in 2014, most developers announced a total new delivery of 1.7 million square meters, which would stipulate about an 80% increase compared to 2013. However, not all deliveries will probably be fulfilled, and we expect that about 1 million square meters will be delivered in 2014. Key geographies of announced new projects include the north, 600,000 square meters, the south and southeast, 400,000 square meters each. The market is still forward-looking, since in 2013, 2/3 of all new take-up was on a not yet built basis. The largest share of contracted space in 2013 of announced deliveries was seen in the south, about 70%, and the southeast, about 43%. And market demand still outweighs deliveries by 21%. In 2013, tenants from the production sector have been especially active, having absorbed about 190,000 square meters of warehouse space. The share of large deals, 40,000 square meters and above, exceeded 30% of market demand. With solid demand and supply, commercial terms remain stable. Vacancies rates are low, about 1%. Prime rates reach about $140 per square meter per annum, and rates in general depend on distance from MCAT and specific location of the warehouse. Summing up the above-mentioned facts, we expect a strong market in 2014, despite some potential for worsening of macroeconomic conditions. There is no sign in decreased demand, and developers focus on build-to-suit projects in order to prevent fluctuations in vacancy rates. We expect solid interest by investors for industrial and logistics facilities, which is further fueled by similar interests in the European market for the same sector.
In 2013, investments in Russian commercial real estate amounted to $7 billion USD. It means 40% growth compared to the previous year. Last year, Moscow was in top 7 European destinations, and in addition to that, 3 out of 20 largest deals were closed here. 7 largest deals accounted for 2/3 of the total investments last year. Unlike in the previous years, investors show strong interest to logistics sector, and investments into this segment amounted to $1.3 billion US. This trend is in line with what is going on in Europe, and this trend is explained by the expectation of the growing rental rates due to accelerating economic growth in Europe. Foreign investors' share remains relatively low, just 27%, compared to the pre-crisis level of 80%. Lion's part of investments came from US. But it doesn't mean the decrease in interest from international investors to commercial real estate in Russia. In fact, we witnessed the shift from stabilized assets to redevelopment and development new projects. Currently, a number of large international investors are looking for opportunities in commercial real estate market in Russia. Prime yields remain stable. In office segment, 8.5%, retail, 9%, industrial logistic 11. Yields on secondary properties are in 9.5-10.5 range in office and retail, 12-12.5 in industrial and logistic. Investments in Moscow commercial real estate generates yield which is minimum 225-300 basis points higher compared to the other European investment destinations. Gap, say, with London is as high as 400-600 basis points. Around half of this spread is related to counter-investment risks, while another part delivered by industry-specific risks. The latter, besides traditional risks associated with the property legal history, include possible changes which might occur as a result of government's policy targeted to decrease usage of the offshore companies in the Russian economy. In 2014, we expect the total investment volume to be at $6.5 billion US. Industrial and logistics and retail segments are perceived as the best bets for international investors. Office sector is expected to be under pressure due to decreasing GDP growth rates and large delivery of new office space. However, this situation might create opportunities for long-term players in core assets and players focusing on opportunistic strategies.